Welcome to Learn by Choice. In this video, we are going to talk about what is inflation, what are the various types of inflation, how it is affecting each one of us, and how we can take measures to reduce the effect of the inflation. Inflation is increase in prices of goods and services over a period of time. There are two methods to measure inflation. The Consumer Price Index, which is also called as retail inflation. The other one is Wholesale Price Index or WPI. CPI may also be used to monitor the retail prices at various locations like rural, urban, and even at all India level. So not only at various locations, but retail inflation can also be used for various commodities. It is very important macroeconomic indicator used by the central bank, that is our RBI, and the government for inflation targeting and bring the price stability and for economic health of the country. For those with regular income, CPI measures the real value of the salaries, wages, and pensions. It actually discovers the purchasing power of each individual. Let us discuss the various types of inflation. The first and foremost is the Consumer Price Index or CPI. CPI measures the change in the retail prices of essential goods and services. In CPI, different weights are allocated to various items. CPI calculates the overall inflation based on the movement of the prices. There is a problem in CPI. CPI may not accurately reflect the consumer spending because of its heavy weightage on the food items in the CPI. You all know that families spend more on services like education, healthcare, and transport. The second is the Wholesale Price Index or WPI. WPI measures the inflation based on the prices at wholesale level, the price at which retailers buy the products from the wholesalers. WPI considers factors like transportation cost and retail markup. WPI does not include services. It focuses only on goods. This is very important to note. Based on the pace of inflation movement, there are three types of classifications. One is creeping inflation. Here, there is a gradual increase in the inflation. It is important that a reasonable increase in inflation is required to maintain the economic stability. Walking inflation, where the prices rise up to 10%. It cautions about the galloping inflation which is going to come. Galloping inflation is when there is rapid increase in the prices of 10% or more. The consequence is that it causes economic imbalance. Hyperinflation is when the prices skyrocket more than 50% in a month. It may be a rare phenomenon in India like country. Based on inflation expectation, there are two types of inflation. One is anchored. Here people are expecting the prices to return to normal after a temporary increase in the price. This is called anchored inflation. In unanchored inflation, people think that higher prices will last longer than the expected timeline. It causes persistent inflation. What are the causes of inflation? Sometimes very big event, war or oil price shocks can raise the prices and also lower the production. Inflation can also be due to demand pull. It occurs when demand for goods and services surpass the production capacity. For example, an unexpected increase in the demand for cars during the post-COVID-19 pandemic led to shortages. This shortages drives up the prices for new and used cars. Inflation may also be due to cost push, which is due to rising prices of input goods and services. It impacts the services of final goods and services. To give an example, commodity prices spiked during the pandemic. It impacts the prices of final goods and services. To give an example, commodity prices spiked during the pandemic. It forced companies to increase the prices to offset the rising production cost. What are the other factors which are influencing the inflation? The first and foremost is the monetary policy of the central bank. Central banks regulate money supply and interest rate to control the boom in the economy. When a central bank increases the money supply or keeps the interest very low, it increases the demand for goods and services. This demand-driven boom makes consumers and businesses spend more money. Inflation affects the savings and investments. Returns on savings is negative if returns on those savings is less than the inflation rate. Let us understand how inflation is calculated. It is calculated as a percentage change in CPI compared to the same period in the previous year. The central bank, which is RBI, monitors CPI to maintain price stability in the economy. Statistical agencies measure the inflation by establishing the current value of the basket of various goods and services consumed by households by creating a price index. The rate of inflation is then calculated by comparing the value of the index over different periods. It may be month to month or year to year. So what investors can do for hedging their portfolio against inflation? Go for long-term investments, invest in asset classes which has the potential for inflation-beating returns like NPS or mutual funds. Invest in commodities like oil, gold or precious metals. Real estate investments offer returns through rentals and capital appreciation. Inflation indexed bonds are also available, which are actually bonds with returns indexed to inflation. Equity investments are also good way of investing to beat the inflation. Let us see some other important information about inflation. The RBI uses CPI to formulate monetary policies. The relationship between CPI and the repo rate influence their policy decisions. There is a recent news that India has witnessed a deflation in the WPI for the September 2023. Let us understand the difference between inflation and deflation. Inflation is a general increase in the price, but deflation is the opposite. Under deflation, a decline in overall prices. Deflation increase the purchasing power of currency. Deflation may also be due to productivity growth and decreased aggregate demand. It may also be due to decline in the supply of money and credit in the economy. The moderate deflation benefits the consumers, but it also indicates a weakening of the economy. Weaker economic scenario leads to recession and depressions. Inflation and deflation impact consumers, business, investors when it becomes extreme. Maintaining the moderate inflation is essential for economic health. It encourages to spend and to borrow. Thank you for watching Learn by Choice. Your subscription to Learn by Choice encourages us to make more and more educational videos.